What's up, guys? Welcome to Financial Dad. I always like to go over it in the beginning and just kind of say what I'm about. My goal with this show, this channel, this podcast, whatever you want to call it, is to shed light on financial hot topics. You see a lot of things being thrown around in the world about millionaire, right on up, and which I get it, but somebody's got to start somewhere. And the majority of my clients that I talk to, young or old, starting or 30s, 40s, 50s, right on up to 80s, is they have so much stuff thrown at them that they don't know what to do. So again, my goal is to just shed education, information on keeping it simple. That's the main focus. I believe that most investing is best kept simple. I'm not sure who I said this, but if you can't explain it to me in under like 2 or 3 minutes, then more than likely you don't need to be in it, and that's for everybody. But again, the goal is to use simple techniques to prepare yourself, your family, and your kids for what is ahead. And if need be, get yourself on the right track with the mistakes that you've made in the past. And everybody's made mistakes, but again, that is the main goal of Financial Dad. This episode, we're going to go over a simple plan to prepare yourself for a home purchase. Again, I'll go over this in detail over the last few episodes of how to prepare yourself. But what I didn't go into is how to prepare yourself because it normally takes a couple years to prepare yourself, and we'll go into details about that. So we're going to go over what do you need to do to prepare yourself for that first home purchase. Home ownership is a lot of people's goals. It's a place to call home, raise kids, have friends and family over, Christmases, holidays. It's a place where you can stand in the front yard and look at what you did for yourself. I remember the last house that I bought, my wife and I bought. We sat in the front yard and we were just amazed at how difficult it was to get into that house. And then like the first week that we were in there, we were amazed that it was our house. And I think that gives people a lot of pride. A lot of home ownership is just like, as long as you pay the payment, then nobody can take it away from you. And so that's what we're going to talk about today, is how to prepare for that. So today I'm going to give you some solid pointers on how to make that happen and make that purchase just a little bit easier. And the main topics that we're going to cover is the thing. So everybody starts preparing for home ownership by going to a lender. No, they don't know what to do, so they go to a lender so the lender can tell you what to do. But there are ways that you can prepare yourself before you ever even go to a lender, because I love all the lenders that send me business, but it is the lender's job to get you qualified no matter what. You want to know where you stand before you even step foot in a lender's office or call them on the phone. And it's very simple to do that. So the things that we're going to go over today is income, credit, debt, down payment, interest rates, and an easy way to figure how much house can you afford to buy. Not what you want to buy, but what you can afford to buy. And there's a big difference between what you can afford to buy based on the math and what you feel comfortable buying. There's a big difference. So for me, I am self-employed. I found out early that I had to prepare 2 years in advance to buy a personal real estate. For today's episode, let's focus on people with a W-2 income, meaning you work for someone. They pay you a salary or a wage, and taxes are taken out of your check. And then the net is deposited into your account. So we're going to focus on those type of employees. Most banks want to see 2 years of tax returns, 2 to 3 months of bank statements, as well as they want to see the account that any monies that will be used to buy that home is coming out of. So those are the three main things that that if you're going to apply for a home, you already have to have that. That's why you have to prepare 2 years in advance, because like we're in 24, but in 23, if you were going to buy a house today and you would have to have 23 and 22 tax returns. You would have to have current pay stubs, and you would have to have W-2s. And then bank statements. And that would be the bare minimum. That's what they're going to ask for first. They're going to ask for you to fill out and then get credit. And then they're going to say, hey, here's 5 things that we need. Because that's what your ability to buy is going to be based off of 99% of the time. And so that's what we're going to do, is that we're going to go over this one by one, and we're going to talk about it and go from there. So again, income is how lenders evaluate if you can afford to buy a house. The easy formula to see what you can afford is to take your annual salary or wage. You can find that out on your most recent end of year W-4. So if you just wanted to take your W-4 from 2023, you take that amount, you multiply it by 48%. Now 48% is what most lenders use as the percentage of income that you can use to pay revolving credit debts. So you multiply again, go back and take your W-4 end of year amount. If there's 2 of you guys and you're married, or 2 people are buying a house, you can use both of them and then multiply it by 48% and then divide it by 12. That's going to give you a monthly amount. My example is this. Take a $100,000 employee, so to make $100,000 a year, you multiply it by 0.48, so that's 48,000. You divide it by 12. That gives you $4,000 a month to use for revolving credit debts. You take that amount and you subtract out any other debts. So for this example, we're going to say that you have no credit card debts, but you just have maybe just some small like medical or like a car payment. So we're just going to say that those equal $1,000. So that's going to leave you $3,000 a month for a house payment. And you have to be very careful, because the difference between home ownership and renting is that owning a home comes with other expenses, other overheads. Nobody ever talks to people about the cost of owning a home. They just come right out the gate and say, hey, you can afford up to a $3,000 a month house payment. And so that would be principal, interest, taxes, and insurance. And what are most lenders going to do? They're going to get you approved at current interest rates on that $3,000, and that gives people a false sense of what they can afford. And so we'll talk about that. Credit, we'll move forward. So the next one is credit. Credit monitoring is very easy. You can use a free service like Credit Karma. And I have always found that Credit Karma is a few points off from what the lender's score would be. For me, Credit Karma was always 15 to 20 points higher than the score that the bank pulls. You have to, and as well as like credit, you have to protect your credit. If the goal is home ownership, then making on-time payments, paying debts off, not incurring new debts is huge. And so protecting your credit score is what keeps you at being able to pay let's say a middle of the road interest rate. If you have questionable credit, then your interest rate can go up. So if you want your interest rate to be, reasonable, then working during that 2 years to keep your credit in a good spot is super important. Debt. I went over debt a little bit above and how it relates to credit, but you have to remember this. You don't need a lender to tell you where you stand if you follow this plan. It's super easy. You don't need to go to a lender 2 years in advance and then work on it for 2 years. You can do these simple steps and figure out exactly where you stand today. It's very simple. There's not an issue with having debt, but all debt payments will come off of that 48%. So again, if we go off the $4,000 number, so the 48% of $100,000, $4,000. So you have, you would subtract all of the debts and the debt payments. Even credit cards with zero balance have a minimum payment of like somewhere between $25 and $35. So everything that shows up on your credit is going to come off of that $4,000. You have to protect your income by not incurring new debts, especially during the loan process. So what I mean by that is that if you find a home that you like, and then you apply for that home, and you think because they gave you a qualification letter and you applied for the home and you're in the application process, okay, well, everything's great. I've seen so many people, even my clients as well as lenders, tell me, man, this guy went out and bought something. Doesn't matter if you got another credit card. It doesn't matter if you got a car. It doesn't mean it could be anything. You could go and charge Christmas on a credit card, and the month that you're trying to close, that minimum payment go from $25 to $200. And that could actually stop a person from buying a home or complicate it. So you have to keep that in mind. Also understand that they will check on this. Before you close on that home, they're going to pull your credit again to see if you've done something like that. And that could either postpone closing until that is cleared up, or in some cases I have seen where the person is no longer qualifies for the purchase of that home. So, and that would be a shocker. Some of the debts that show up on credit are other homes, cars, credit cards, school loans, medical debts, and any debt that you have to give them that is on your social would qualify to come off of that 48%. So guard your credit and be super careful about your debts that you have when you're in that process of wanting to buy a home. Down payment. So there are loan programs out there where you don't have to put anything down. It does not mean that it won't have fees to close, meaning that just because you're getting 100% financing, you still will have closing costs. You'll have insurance, you'll have prepaids, you'll have the lender has to get paid sometimes, so you will still have closing costs. But your lender can tell you what those closing costs will be based off of the type of loan that you're applying for. Now, if you're going to put money down on the home, that would be cost plus. And so, meaning that you still would have those closing costs, but then if you're going to put 10% down, then it would be 10% of the purchase price plus that. So for the down payment, you have to be prepared for closing costs as well as the down payment. You have to have that money in an account. Whenever you start the loan process, you have to show them that money is there, meaning that a lot of people say, okay, well, my dad's going to give me $10,000, my family, somebody's going to give me money. Well, talk to your lender about seasoning. So what that means is that if you apply for a loan like on 9/1 and you give them July's and August bank statements, if that money was not in there in July, then it hasn't seasoned. And so that would be an issue. So make sure you talk to your lender about that. I know that this is a daunting number, and this is kind of a number that whenever you tell people that this is what people used to put down on homes, it was automatic. But with home prices continuing to go up, it becomes a hardship for people to do what I'm going to go over next. But the magic number to pay down on the house is 20 to 25% to get the best rate. That would keep you out of a PMI, which is an extra fee that is charged for borrowing more than 25%. So when I bought my first home, I didn't put down 25%. I put down 5%. So what that means is that PMI is basically private mortgage insurance. It's everything that you borrow above 80% of the sales price. So if you've had a $100,000 house, everything that you borrow above 80% is going to have a fee, an extra fee attached to that amount of money. So if you put down, if it was a 100% loan, you're going to pay a fee on that extra 20%, so that $20,000. And so that is figured in with your pity payment, principal, interest, taxes, insurance, and then PMI. And all of that would have to be, that overall fee would come out of your 48% that would figure if you're eligible. Again, for me, I didn't put down 25%. I put down 5%. And so I always found that extra PMI, even though I couldn't do it couldn't do it. What I did is I did go to my bank and I said, how much is the fee? Now, sometimes the fee is so small, you really don't care. And so, but sometimes the fee can be larger depending upon the bank. And that's what you would really want to work to get that, get the amount that you borrowed down to 75, 80% of value. But I would know that up front when you're talking to your lender, so you have a plan to get the amount that you owe down below that. And then what you do is when you're inside of your loan, you can request by letter to your lender, say, I need PMI taken off. You might have to pay for an appraisal or something like that to get it taken off, but they will take PMI off. Also, be careful with a lender that tells you that all you have to do is refinance down the road. That's what they like to say, down the road if rates go down. I do a lot of business with a lot of lenders, but again, their job is to get you in that home. And I'm not going to say that there's lenders that do bad business, but again, I think that these are the things the questions that you need to ask beforehand. And this is pretty simple to do. All you have to do is do the math. Unless the property value goes up and you have enough equity in your home to refinance, then refinancing is not an option without you pulling more money out of your pocket. And if the equity didn't go up and you didn't put a lot of money down, then where is the money going to come from? If you couldn't put money down then, unless you're expecting some windfall, the reality of it is where is the money going to come from for you to refinance? And so again, if the value of the property does not go up, then where does that money come from? And if you can't pay it then more than likely what the lender is telling you is true. You can refinance later, but there's more to that than just the words. So I find that most people that borrow more than 90% of what they buy the home for. So if you're borrowing 100% all the way down to 90%, most of the time you have to stay in that home for around 5 years to get the mortgage paid down enough for you to refinance. And so just being transparent whenever I say that. So make sure that you have a solid conversation with your lender about that whenever they say, hey, just if the rates go down, refinance. Okay, well, that sounds great, but there's more to it than that. Interest rates. So interest rates are a big deal right now because for like my age group and people who have owned homes, then we remember when interest rates were 3%. But like I tell my clients now, if you've never owned a home before, then you don't care about a 3% rate because you don't even know that there were 3% rates 2 or 3 or 4 years ago. So you need to focus on what rates are today. And if home ownership is your goal today, and that's all you need to focus on. Right now, with interest rates being around 6%, people are waiting. I talk to a lot of my clients that are waiting for interest rates to go down. From the research that I have done, and you can do your own research on this, that is a fool's goal. It is not practical. And what I mean by that is even if interest rates come down, with home prices won't come down. So all that has to happen is that if interest rates come down, but the home prices go up, then all you're doing is just paying a little bit less interest because all interest rates move are about a quarter at a time. Sometimes 25 basis points, sometimes 50 basis points of 0.5 or 0.25. But if home prices went up by on a $100,000 house, supply and demand, because there's not a lot of houses out there, if the home prices go up, then you have accomplished nothing. You haven't done anything. And those are simple numbers. You can use any financial calculator and just look at it. So if a $100,000 house at 6% interest, principal interest is this. $110,000 house at 50 basis points lower than that, you get that same number. There's not going to be a lot of difference. So over the next, so when interest rates come down, the reason why the interest rates coming down and the home prices are going up because of the low supply, there's going to be a lot of competition for the homes that are out there. Because I believe that a lot of people are sitting on the sidelines waiting to sell their house or waiting to buy. And so when that happens, you're going to have competition. And if you're in competition with somebody else who can afford a larger down payment or a larger due diligence payment, or then you're going to lose. So I always believe that if you've done your due diligence on your finances and then look back at it a couple of years, there's nothing stopping you from buying a house. It is if that's your goal, then just do the math and go buy your house. So here's another thing too. So even if you have to find a different house at a lower sales price, it's always better to do that than it is to hope that rates come down. Hoping never wins with money. There's a lot of foolish hope in that mindset of saying, I'm going to wait until rates come down. So this takes us to the last tip on buying a home, which is choosing a home. There are a lot of factors that play into this, a lot of emotional, make people happy factors, but my 2 cents is this: the math never lies. Do the math on your income based on the $100K salary with $1,000 in other debts. That leaves around $3K that you can use for debt service on a home. But please make a wise choice. I tell all of my clients, please don't use all of the $3K. For this example, let's say you're a first-time homeowner. Find you a house that is reasonable, a house that can be rented if you decide to sell it or rent it out, whatever time, 5 years later. A house with low maintenance, basically a home that other new homeowners will want, just like you did. For me, I use 50% of whatever I have left after the debts, so around $1,500. That is $4,000 minus the $1K in debts that you have, leaves $3,000, then half of that. You can then use any financial calculator to work backwards and see how much house you can use. The reason why I say that is because a house comes with expenses that renting does not have. And so you have to be prepared for that. And just a lot of people don't think about the overhead that it costs to own a home. A quick example for this is a $200K house at 6%, 100% finance would have a principal and interest payment of $1,200. Then you add insurance, taxes, and other fees like PMI, association dues, etc. I see too many people buying too much house and then being surprised with how much it takes to upkeep that house. I tell all my clients when it comes to home ownership, paying a house payment is the cheapest thing that you will do. So just be careful and don't bite off more than you can chew when it comes to buying a home. So again, buying a house, there's a 2-year look back period for most banks, so prepare for that. Protect your income, your credit, keep your debt low, and don't create any new debt. Be prepared if you want to put money down. Find out how much that will be, plan for it. You don't have to have a lender tell you all this. Save for that. Know how the interest rate plays into the purchase, but don't let your interest rate stop you from purchasing. And the most important tip, figure out based on above how much house you can comfortably afford. A home is supposed to be a place of peace, a sanctuary. Don't make it a prison because you didn't prepare. That's it for today. Good luck, everyone. Hope this information helps you move forward in home ownership. If you have any questions about today's info, comment, and I will send you some simple sites and tools to help you make a solid decision. As always, keep your eyes on the prize and not in the rear view.